Welcome to the Diver and Apartment Investor Podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We've got Patrick Grimes with us today. And for everybody listening out there, I think Patrick's one of the first people I met when I started jumping into multifamily. So probably known each other for a good 6 years now. So Patrick, welcome to the show.
Yeah, glad to be here. Reminiscing back at the days when we were on that mastermind Slack channel, underwriting deals together.
Absolutely.
And
Yep.
I met you at a conference, man, back in the day.
Back in the day,
Yeah.
I signed up for Michael Blanc coaching in November of 2018. And I don't remember if you were at the first conference I went to or the second conference I went to, but if you were at the first conference, it's been 6+. If you were at the second, 5.5. But anyway,
Wow.
it has been a while. It's been a long while, but good to have you on the show again. Very much appreciate your time. And why don't you tell us a little bit about your background and what got you into multifamily, and then we'll start talking about the other stuff that you're in as well.
Sure. Well, I started out like probably many of your listeners, high paid professional. I was a mechanical engineer. I did high tech, automation, robotics for manufacturing, mostly new product development. Places like Facebook, Google, Lockheed, Raytheon, Boeing, Johnson & Johnson, Abbott, kinds of cool stuff. I'm a geek at heart. Always been there. But when I asked the owner of the first machine design firm that I worked for, hey, where should I invest? I'm making some money now. And I was expecting him to say, hey, this medical device that, we know this one, or go invest in this startup or whatever it is. Yeah. He didn't say that, actually. He said, take your money high tech, put it in real estate. I diversify as much as you can, as soon as you can, outside of high tech. That will help build your long-term financial health that you and wealth that you want for your family. Because he rode his whole career, this constant wave of the ebbs and flows of the high tech industry and the stock market. And he saw that what really was rewarding was his alternative investments. And so I learned hard, though. I lost everything on the first one.
Yeah. Diversification. So you went from tech into real estate. How did your first investments in real estate, how did you find the first investments and how did that progress?
Oh, so back then I was a snot-nosed engineer, really aggressive, right? I've been saving all my bonuses, pretty successful. And so I decided to go big. I researched the highest returning deals, and I thought I had done my due diligence. I had just not learned about market cycles yet. This was back in 2007, right? So I went heavy into a pre-development that was destined to double and triple my money, and I was going to make it rich. Thank goodness I was a successful day job engineer at the time, because I lost my shorts, my shirt, and everything else through 2009 and 10.
Yeah. So you lost stuff in the 9 and 10, going a little bit aggressive. What got you back in?
I was still a successful engineer. I rode that corporate ladder, got a master's in engineering and an MBA. I started a separate company where I was a little bit higher ranking, and to use military terminology. And
works.
I found myself looking for where to diversify. I still believed in the message of allocating into other investments that don't ride the same market cycles. And when I started doing the research, started attending webinars, reading books, listening to podcasts, real estate kept coming back, but I started learning about how it can be done in recession-resilient markets. You can buy existing assets for cash flow, and you can make more measured improvements that you can more calculate versus hope on a new development and hope that the market's not going to take a cycle. And so I started buying single-family homes in Houston, renovating, refining, renting. I was doing BRRRR method before I knew what BRRRR was, and it was working. It was working great, and it was complementing my allocation, my other investments, and it was brutal. I was traveling all around, having a great career, really good at making money. My night job began to just really be a challenge for me. And so that was the real estate career. Then I met my wife, and after that, I realized I gotta pause. So actually, she was the one that she was a reason why I just took a break for 2.5 years. And when I came back at it, I started going bigger, scaling, apartment buildings, that kind of thing.
Nice. When did you start actually? You said you talk about starting investing on your own. When did you start thinking about, hey, this is working for me, I'm going to invite all my friends to do this as well?
So those conversations, I had built out some networks when I was doing single family, 15 years ago, or I started working with some contractors that could help me innovate, and started really building kind of a a long-term strategy. But it wasn't, I started doing multifamily and I realized I don't want to do all these jobs. I'm really good at engineering and analyzing. I don't want to do every job. And I'm not
Yeah.
physically in the markets that I want to work in, I want to invest in. I need to find partners that are physically in these markets.
Yeah.
And I need to find people that can do the ongoing asset management that specialize, and that's what they love to do. And I, like you, Brian, we can hunt for the next deal. We can underwrite. We can talk to brokers. We can solve the complex problems of putting and structuring these deals. And that's where I felt like, at first, that's where I felt like my sweet spot was. And so that's where I went to go. That's what I went at full bore.
Yeah.
And instead of doing it all on my own, I started partnering up with people that were way more successful and been doing this for a lot longer. I learned a lot faster that way. And that's really what kind of got me into the space.
Awesome. All right. So now you've done a lot of multifamily, and you do more than just multifamily, more than commercial real estate. And you talked about early on being this diversification. What's your philosophy about diversifying, first of all? And then, answer that question, and then we'll go on to other stuff. How about that?
Yeah. So any of our decks, you're going to see allocations published by different institutions, strategies about how the wealthy, the middle class, how they allocate. You're going to see it's pretty consistent that around 25% allocation goes into real estate of your wealth, another 25% in alternatives. As you get more wealthy, that grows actually. And then there's a 50% kind of traditional sort of stock portfolio, bonds, treasuries, cash flow, fixed income. So the question is really, when it's very easy for people like you and I to get way over allocated into real estate. When you get very comfortable and good at something, you get way over indexed in that one thing. And I've felt that pain before, and I was all in one thing.
Well,
and
I am way over allocated in real estate right now. And I recognize that, it's one thing that I'm trying to fix as money comes in. But anyway, sorry for interrupting you. Keep going, man.
That's all right. It's a journey for everyone. And that's what we try and talk about, that sense of comfort that we get from maybe being in the stock market or maybe being one kind of real estate in one market or whatever. That sense of comfort where we just keep doing that is actually creating a discomfort in the foundation of a portfolio, because a portfolio needs to be able to ride the waves and the cycles of not just different geographic trends, but different trends across different asset classes. And so it's important to look at other things. And that's why you've seen us do some energy, and you've seen us do right now litigation funding. Because when you look at asset classes, you could be, well, what about medical? Everybody knows healthcare is steady, tried and true. What industries are there out there that you can invest into? Well, there's oil and gas. Well, it's super volatile, but it doesn't trend with the real estate market. It doesn't trend with, well, what about plumbers, right? What about attorneys? What about HVAC companies, right? What about dentists? These are all things that are needed regardless. Education. People need upskilling and reskilling regardless of the market size. We call these non-correlated investment strategies, are non-correlated to others, or they're cyclical, counter-cyclical, to others. And so that way, build a more, not a financially independent portfolio that's overhedged into one specific sandy beach that can get washed away, but like I had before. But you really build financial security, which is lots of allocations into non-correlated, where if you put an investment in our litigation fund, that you're lending into attorneys. And that is just straight as an arrow growth industry, regardless of COVID, regardless of the housing bust, the dot-com boom. It just doesn't care. It just rides the straight arrow. In fact, there's even arguments that it is counter-cyclical, because in tough times, attorneys tend to get busier. People tend to get more litigious. And so those are the kinds of investments we look for. And that's why we put together these alternatives that traditionally only available, and also they're highly sought after by more sophisticated investors, hedge funds, the sovereign funds, the private equity firms that are saying, look, I've got to find these other allocations. Where do I go? And they then invest into these. And just a handful of people in our spaces even know they exist. And so that's what we're doing. We're kind of bringing that institutional quality level asset class to accredited investors.
Yeah, just to some of your points, one group I follow a lot's Tiger 21, and I listened to one of their chapter presidents, and I love how simple he made it sound. It's not as easy, but he said most people create wealth by focusing on one thing, and they keep their wealth by diversifying. And that's kind of like when I'm looking at what I'm doing right now. I am hyper focused on multifamily, but as deals come full cycle and I'm getting large paydays, I am looking for places to diversify. And I want to say Tiger 21, they do their quarterly reports, and they're at 25% real estate. So
Yeah, and
that's about where
27
they hover.
private equity, right?
Yeah,
27 alts that are non-real estate,
yeah.
right? So where is that? That's what we're
Yeah.
helping to fulfill.
Yeah, something else that's fascinating for me, but I like the VC. I'm very, very interested in looking at some of the venture capital funds. But let's start talking about some of the other things that you mentioned. You've done some energy, oil and gas type investments. You're doing this litigation fund. Let's talk about some of the other things that you've done and some of the pros and cons to those.
Well, so we stopped doing the traditional buy a property and renovate it and increase rents to create value, force that appreciation. That was sort of the strategy in the single family, and it was the
Mhm.
strategy in multi up until we saw interest rates rise and then bigger than
Mhm.
the Great Depression. And there's usually a downturn subsequent
Yep.
to that. So we saw both residential and commercial, but much more so in commercial,
Yep.
devaluation.
True.
Same time, we saw banks start to struggle because interest rates remove their liquidity, struggling portfolio of loans that aren't paying off hits
Hmm.
their liquidity. So we really stepped into, last year, beginning of last year, so not 2024, but 2023, in the beginning of 2023, stepped into it saying, look, how do we win from the upside of this downturn? Right. And because I've seen it firsthand. And
Hmm.
so we kind of stopped doing the traditional renovate value add type strategy. And we said, look, let's press a reset button. What is the best way to proceed in the new year?
Hmm.
And so for over a year now, we've operated two different funds that are specifically opportunistic in nature, and they're just killing it, exceeding our projections. And it has to do with our pipeline of deals coming through.
Hmm.
And as I mentioned, as an engineer, as an analyst, by heart, you can see that they no longer pencil.
Yep.
Inflation has hit the payroll, inflation has hit the cost of materials, inflation has really hit the bottom line while insurance
Yeah.
prices are growing aside from interest rates. And with the banks not lending, it's hard. People haven't been able to finish their business plans. So we're like, how do we help these operators? Because I'm not insulated from this, but we see it as well, the stress in
Yeah.
our world. There's a lot of operators right now that have great performing properties.
Hmm.
They just didn't have the right
You don't
foundation.
have
They
the right
had
debt. Yeah.
debt. Maybe their capex reserves got dwindled over time
Hmm.
as they weren't able to execute. Maybe the eviction moratorium hit them for
Yeah.
whatever reason. There's a million things that have been going wrong. It's been a
Hmm.
perfect storm. They got a great property, but either they need more time,
Hmm.
but they can't get a loan, or they found a great property and they want to buy it, but they can't get a
Hmm.
loan because the lenders are just delayed and constantly retrading, or they have a property that's performing, but they want out. And
Hmm.
it may be because of this asset or other assets in their portfolio, they need to liquidate this. And so
Hmm.
we created two sister funds. One is an income fund, which is a real
Hmm.
estate asset backed debt fund. So if they need or want more time, we can lend to them. And we have an originator
Hmm.
called Pimp Lending. And what's really fascinating is that these
Yeah.
same assets, commercial assets, 2 to 6 million roughly is our buy box. This sort of smaller end assets,
Mhm.
wholly unserved right now by banks
True.
and lenders. They're just ignoring these poor guys. There's really nowhere for them to turn. The interest rates that used to be 6, 7, 8% are
Mhm.
now 12, 13, 14%
Yeah.
for these assets, and in some cases 16. And they're happy to pay it.
Mhm.
And they're happy to pay it to us because they can trust us to actually deliver to fund. We can close quickly. We don't take 30 days, 60 days, 90 days, and then constantly change the terms along the way. And so PIM Rapid Lending has been incredibly successful. That income fund, we have investors can participate in short term from 90 days, six
Mhm.
months to a year, or 3 years. And the returns have been either fixed interest, seven,
Yep.
8.5, and 10 in the short, or we've been distributing 14 plus monthly distributions in the 3 year
Mhm.
lock. It's just amazing
Yeah.
how you can be in a 60% loan to value debt fund and getting equity like returns for this opportunistic time. And so we did that.
Wow.
And then we said, well, what if they don't want more time? What if they need or want out?
Hmm.
And who's going to buy these things? So we have an acquisitions fund, which allows us to move opportunistically to buy in cash assets at a good basis and build a fund through
Hmm.
this time. And the best commercial buying opportunity of my lifetime, it has now dropped, commercial real estate has now dropped relatively lower than it did in
Yeah.
2008 and 9. So this is actually the best time. As much as we can, as quick as we can, refinance out, buy again, 1031 exchange. And instead of distributing when we have a sale event or a refi event, we compound the returns by buying more
Mhm.
assets, constantly trade up. And we've just been killing it on the returns in that fund. And so those are both opportunistic in nature. And I'm really excited about those two projects.
Yeah. Awesome. Awesome. Well, that's pretty amazing. And it's one of these things, I saw, I think you're one of the first people I saw pivot. I was going to use, say, flee some people have like just completely fled from multifamily, but, it really made me think a lot about, what did I want to do? I think the writing was on the wall a couple of years ago that, multifamily wasn't going to be doing great for a while. And I think a lot of people did do something similar. What I definitely like about how you're doing things, I love the non-correlated asset philosophy. It's making sure that what happens to the market isn't necessarily going to happen to everything. Because when you're investing in the stock market, most of those things are correlated. Investing in real estate, all that's correlated. If one asset type goes down, most of them are. But love that you're taking that more balanced approach with your investments. You talked about how like the ultra wealthy are investing like this. What does your typical investor look like? Are you getting a lot of ultra wealthy? Are you getting up and comers, or what's that look like for you?
So we've always done, me personally, I've always had, call it Reg D 506C offerings, which are accredited investors
Yep.
only. And our investment minimum have always been $100,000.
Hmm.
That allows me to get on and talk publicly about our investments.
Yeah.
Our average investments have been anywhere from per deal 140,000 to 200 and change. So
Okay.
it is true that we do have wealthy individuals. I am constantly talking about balanced allocation strategies, and we have our Mastery series where I bring on new sponsors every 2 weeks talking about different alternative investment strategies. And I'm constantly saying, don't put more than 5% of your wealth in one deal.
Hmm.
Make sure that you're spreading it out within different assets and across different assets. And so
Yeah.
I also share that with my investors. I can't give financial advice, tax advice, or
Hmm.
legal. I'm not a financial planner, an accountant, or an attorney. But for those same reasons, it tends to be those that have a little more wealth,
Hmm.
that have found themselves in the stock market and or real estate, maybe in oil and gas, but don't have the stomach for it. Man, commodities are volatile, but they're really just looking for that next allocation to feel, they're feeling overexposed, a little
Hmm.
insecure, even though they feel comfortable in real estate, they're feeling
Yeah.
overexposed and insecure in that. They see that we're just hit a crazy high, fast rate hike, bigger than the Great Depression.
Mm.
Wow, our spending is out of control, and the world's biggest economies are betting against the dollar. 11 out of the last 14 Fed rate hikes ended in a bust. So they're
Hmm.
seeing their real estate portfolio struggling. They're seeing their equities struggle and be in a precarious situation right now, probabilistically. I mean, you always need to be allocated, but especially today,
Hmm.
most of the investors, they get to that point, they really truly look at, they build the pie chart, they put
Hmm.
in that pie chart where their wealth is, and then they put a confidence on their security. And you start really looking at that and then exposing where you feel insecure. And then
Hmm.
those are the kind of people that are looking for allocations in education, healthcare, real
Yeah.
estate, litigation funding, these other allocations into super stable industries where you can put something there and you
Hmm.
can go to sleep knowing that regardless of whether or not the market crash or the real estate crashes like it has in the past, it does on cyclic terms, you have something somewhere else that just follows the judicial process, of the United States government, and those returns are going to come back to you.
Yeah, yeah. How would you recommend that people start learning about alternative asset classes? And just kind of one step deeper, obviously most people before moving out of the stock market into real estate, they do a lot of learning. But how do you find out about, investing in attorneys or investing in, the plumbers of the world?
Yeah, so We have a platform, passiveinvestingmastery.com. So this is because I was once, just like many of your listeners, a high paid professional that had no idea any of this stuff existed. So part of our mission is to help our investors build true financial security, not just by our investments, but by gaining mastery in the art of passive alternative investing. And we do that through our mastery series. It's every 2 weeks. Every 2 weeks, we bring on different sponsors. We've had precious metals, technology metals. We had mining.
You've had this guy on there. Yeah, I've been on there. Yeah.
Yeah, we've had laundromats. We've had blockchain, crypto. We've had just about every possible, like bourbon barrel cask investing, alcohol bev investing. We've had oil and gas investing. So we bring ATM machines, just every possible strategy that's out there, we bring on, and we bring on both sponsors that sponsor those kinds of investments, and we bring on strategists, tax people, IRA people, legal, asset protection, all the people you need on your team to be successful, and all the alternatives out there that you can choose from. And that's me doing a blue ocean approach that I didn't have when I was looking for where to invest, because I had no knowledge of any of these strategies and nobody was pointing me towards them. I had to find my own way. And now it's just, you know how it is, Brian. It's just a handful of us that trade the baseball cards of alternative investments, and nobody else knows about them, right? So somebody's got to get out there and show. And if they choose to invest with us, sure, we sponsor deals, but they're going to do so knowing that they've made a selection against all the different alternatives out there. And as they get into that space, they start seeing the different kinds of asset classes, just like our debt fund is just our litigation finance fund is just like a real estate debt fund. They'll start seeing the similarities in the structures. They'll start applying what they already know to other industries. They'll become more familiar over time, and they'll be able to start allocating and building a more secure financial future, as opposed to just independence, right? In your IRA account, or independence in your one investment, strategy. So that's what I suggest people do.
Yeah. What I'm doing in a lot of ways too. Now, my philosophy is I'm trying to learn one thing at a time, so I think I'm pretty good at real estate investing. Yeah, but I'm starting to go to a lot of events that are tech investors. They're big tech scene in Salt Lake, but starting to go to a lot of these events where there are deal pitches and things like that, so I can learn that industry. But yeah, my goal is to kind of learn one at a time, and then just start branching out, But yeah, I love your investor series. Something else that really resonated, and it was a while ago you said this, when I approach investors, you said you recommend nobody put in more than 5% of their net worth. But, I show them a lot of times the Tiger 21 allocation and say, hey, 25% of your allocation should be into real estate. And then, of course, I try to gobble up as much of that 25% as I can, is my goal. But yeah, so alternative assets. Awesome.
We educate a lot on litigation finance, and I'd love to share a little bit about it if that's okay.
Let's do it.
It's pretty cool, like the actual underlying investment, right? Because just like in real estate, how you're ultimately providing housing to tenants, right? And which is cool. There are harmed individuals out there that were typically, in our case, harmed by a large organization or corporation, that the harmed individuals don't have the money to defend themselves or to seek justice, right? And they're up against this big Goliath out there. And there's these attorneys that are willing to work under a contingency basis and essentially take all these harmed individuals and help go against the Goliath. But it's expensive for them. And they need people to partner with, even when it's a sure case. Like we were talking about how we're heavily involved right now in the Camp Lejeune water contamination. I mean, for 17 years, the government fed our military and civilian and their families contaminated water. I had a Marine base where people went to go train for war. And I know you were stationed down the road from there.
Yep. Yeah, I've drunk Camp Lejeune water before, but few and far between. So I'm pretty sure I wouldn't be eligible. But that one's near and dear to my heart. Now, are these the same thing as class action lawsuits, or do they start not as a class action? I'm not even sure where that goes there. But
yeah, and so wait, but first, it's also near and dear to me. I was born on a military base in Italy, right? And it could have been Air Force Base. It could have very well have been my family and me, right? Exposed. And I have 2 apartment buildings and right next to Camp Lejeune. So it's like, gosh, like those are military people, but so it gets a small world. But no, they're not class action, actually. We don't like class action because class action doesn't provide meaningful settlements. And part of what we want to do is we don't want to be class action. Oftentimes, you probably somehow got involved in one, and maybe you got $75 from Lynn's Crafters or $50 from Radio Shack or something. Who knows? Like it's really meaningless to the claimants. We're looking at
or from Tenant Screening Report Settlement Fund. Yeah, I got like $85 from them last week. Yeah.
Yeah, nothing. And so it really is not going to change your life. We're actually providing real settlements to people that were injured that can change their life. And that is more what they call mass tort. And it's just a word for meaning a mass amount of people were harmed. Tortum in Latin means harm or injustice. So when a lot of people had a harm or injustice done to them, they're allowed to seek justice through the legal system, through the courts. Well, that's what litigation is seeking justice through the courts. And so that's where we're interested. And it's not one lawsuit like a class action where you're in one lawsuit. Each of the independent people on the docket. So we're lending to attorneys that are representing thousands of people that were harmed at Camp Lejeune. And those are all individual lawsuits. And each one of those can get $100,000, $200,000, $400,000 each. And will help to help the attorneys find more similarly harmed individuals to acquire those clients, right? And add them to what they call their docket, right? Or we'll help those attorneys support the costs, their hourly rates, court fees, filing fees to get them across the finish line to settlement. And when it's very late staged, like in the case of Camp Lejeune, there was a bipartisan piece of legislation passed saying that the DOJ they caused it and they're liable for it. They actually put an early settlement grid together saying, based on how long you were there and what your injury was, here's your settlement. And they said, here's the justice fund we're going to use to pay those settlements. People can settle today. At this point, it's a very safe bet comparatively because you can take these people and they can just settle today. And so it's easy to underwrite the payout, right? Some of them like that, the ones we're interested in, causality and liability, pretty much the defendant is now looking at what are they going to settle for. And it is the case that people come to me like, well, what happens if you lose? Well, we're not involved super early when there's a high loss potential. And if there was, you'd potentially have a much higher return, just like if you were in an angel investment.
It's risk versus reward. Yeah, exactly.
Or a oil and gas wildcat deal. You can make a 30x return.
Yeah.
Or like me, when I was doing a pre-development, I was looking for a huge return. But if you're very late stage, where we're through the courts, they're settling, it's actually 90% of civil cases settle. So it's not the case that a lot of these things, and a lot of times the insurance companies force that, right? So it's not the case that there's a high probability of loss regardless, but even so, we're late stage. We get a reasonable return, 20, 30 IRR as opposed to 30x, right? When there's a big total loss potential. But between the ones for the government, Camp Lejeune, also the military and civilian firefighters were involved in that one where firefighter foam that was used, 3M actually said, 3M Bayer, or DuPont 3M said, you can actually eat this stuff. Turns out it's a forever chemical, a PFAS, this foam they use on fires. And as it turns out, when it gets superheated, it becomes incredibly toxic. And so now they're suffering from non-Hodgkin's lymphoma. And so we're working on getting cases like that through a couple partnerships. And also like RoundUp. RoundUp, weed killer, Monsanto, now Bayer, said they even had falsified reports that are since been retracted by the EPA saying it was healthy. And these landscapers and farmers are now having horrific diseases. And they've been settling these. And so we can help our attorneys find more similarly harmed and help pay to get them across the finish line. And you can provide that access to justice and you can get a preferred position. The claimant gets paid out first. We get meaningful settlements, usually 50 or 60%. And then we only get involved in cases in which that leftover part, that contingency fee can, with our borrower, can then pay off the investors, pay a reasonable kind of waterfall split, and then give back the attorneys the upside they're looking for.
Nice. So to mitigate the risk in this, you're doing the late stage, where, it's all but done, you're just taking that last little piece across the finish line. All right. Well, that sounds pretty interesting. We are about time where I usually like to wrap up. So we're going to start doing that. So one question for you, and we're going back to your real estate roots for this question. It is an apartment investing podcast overall.
Right.
After all. So how about this? What advice would you give to somebody who is looking to get into real estate investing as an operator, a capital raiser like us?
It's a multi-step process, right?
Mhm,
Because the first thing you got to do is you got to educate, you got to learn, and you want to surround yourself with the right
mhm,
kind of people. So I run every morning the podcast. So I call that passive education, where every morning podcasts, TED Talks, audiobooks, I'm learning about something new every morning. But then, when I started out once a month, I would force myself to get to some kind of
mhm.
event, like a meetup group, or where I'm surrounding myself, building a
Yeah.
tribe, building a group of people that think differently, that have succeeded at doing these things. That's how I
Mhm.
met you, Brian.
Yeah.
And that can start to shift my mentality. You are the sum of the people you hang out with. So take passive steps every day, take active steps at least once a month, if not 2 or 3 times a month, to get physically nearby and surrounding yourself with those people,
Mhm,
and then learn how to partner. And I think that's what I did wrong for a lot of years is I thought,
mhm.
well, man, I'm such a good engineer, and I get the same thing with lawyers. I get the same thing
Yeah.
with doctors. I can do this too. And man, they don't remember what it was like when they were studying for the bar. They don't remember what it was like when
Mhm.
they were going through med school. It's brutal at trying, and you're competing against these other
Yeah.
people. And this is their full-time gig, right? And they've
Mhm,
they've been in there forever. So partnering up was certainly taking less of the deal myself, finding people that know how to do it, and
mhm.
then finding my complementing skills and figuring out how to stitch together a team. That was really good for me to get into the space.
Yeah. Love that process. Last question. How can people learn more about you?
Yeah, so I'd be happy to offer a free copy of my book that I contributed towards, if you'd like,
Mhm.
Brian, to your
Yep.
listeners. All right, so but make sure that you put Brian's name or the name of this podcast, but
Mhm,
go to
mhm.
passiveinvestingmastery.com/book. That's the secret link.
Yep.
Passiveinvestingmastery.com/book. The book is
Mhm.
called Persistence, Pivots, and Game Changers. It did make an Amazon #1 bestseller. Turning
Nice.
challenges into opportunities. This is Phil Collins, lead guitarist, the Def Leppard. There's the engineering geek me in the middle there, and then there's some real estate, NFL, NBA players, entrepreneurs. It was just such an amazing book. I wrote a chapter. I told my whole story about
Mhm,
losing it all and coming back in, and all the ebbs and flows. And it's just such a cool book. I've gotten a lot of feedback. It helped inspire people on their journeys because I
yeah.
broke free of engineering, right? I mean, I still love
Mhm,
it, but I found things that are more fulfilling for me and my family's future. And so I'd be happy. I sign them and I
mhm.
send them out. As long as you put where you came from, because we get a lot of random forms getting filled out. And I don't,
Yeah.
we don't know who those people are. So maybe set up a call at passiveinvestingmastery.com. You're going to see our 3 investments, our income
Mhm,
debt fund, our acquisitions fund, all exceeding our projected returns by a long shot, and our diversified litigation portfolio. And you set up a call, regardless of where you're at, even if you're not accredited. Happy to talk to you. It's one of the things that I love to do in this world is invest back into other people, because I was once kind of lost in my day job, not knowing how to get out of
mhm.
it. And so happy to participate, get you pointed in the right direction. Set up a call and let's have a chat.
Awesome. Sounds good. And we'll put a link to that in the show notes. And I'm going to get my autographed copy of the book as well, stick it on my shelf and show it to everybody when they come in the house. But
Where to
there
sign
we
it,
go.
Brian.
Awesome.
Oh,
Well, hey,
don't forget
good.
to join my mastery series too. I forgot to say
Mhm,
that, because that is the series right there on the homepage, that every 2 weeks it's a different alternative investment or a different investment strategy, or a new team member potentially that you didn't realize you had, to help propel you into success in alternative investing. So the alternative investing mastery series. Sorry about that. Don't forget to register for
no
that.
worries. Awesome. Awesome. And you said that was also on your website, right? Okay, cool.
Okay.
So
Yeah.
passiveinvestingmastery.com, that's where you go to get everything you need. And Patrick, thanks for coming on the show today. Very much appreciate your time.
Glad to be here. Thanks, Brian.